A federal couple told me the other day, "Tom, you traumatized us with your RMD graphs." And they were joking, sort of. So in this video, I want to show you why those graphs scared them, and more importantly, how we fixed it. If you're a FERS employee in your 50s or early 60s, married, and you have a decent TSP balance, this video is for you. We're going to talk about what RMDs actually are, how they stack on top of your FERS pension and Social Security in your 70s, and some simple steps you can use in your 50s and 60s so those graphs feel a lot less scary. So let us start with the problem. Most federal employees I work with judge their retirement by one number, and it's the balance of their TSP, or maybe it's their pension estimate. They feel either relieved or they feel behind, but they almost never look at the whole income stack together in their 70s. Here's what can happen. Your first pension starts and that creates the base paycheck. Then one or both of you turn on Social Security and you get to breathe a little bit. Then your early 70s hit. The IRS says it's time to start taking required minimum distributions from those pre-tax accounts. And those withdrawals land on top of everything you already have, which can mean higher tax brackets, more of your Social Security becomes taxable, and higher Medicare premiums later down the road. Now, I want to be clear, this isn't to scare you. This is about giving you a simple picture so you can make decisions while you still have time and the most options. So what's an RMD in plain English? A required minimum distribution is the government's way of making sure money you never paid tax on eventually gets taxed. So if you have traditional TSPs, traditional IRAs, or old pre-tax 401ks, you cannot keep that money untouched forever. In your early 70s, the rules say you must take out at least a certain percentage every year. That percentage starts lower and goes up over time as you age. So let me give you an easy example. Say you have a traditional TSP worth $1 million when your RMDs start. The first year, the required percentage is a little under 4%. So the required withdrawal is around $40,000 that year. That $40,000 is on top of any pension you have, on top of any Social Security you have turned on, and on top of any other income you might have also coming in. Now, for most couples I work with, the real issue is not understanding how all of that stacks up in one single year. They see a pension chart, they see their Social Security estimate, they see a TSP statement, but they never seen a single picture that combines everything together. So here's the income stack I want you to see. Imagine a married federal couple. They retire with a FERS pension of about $40,000 a year. Later, they both turn on Social Security. Together, their checks add up to about $50,000 a year. So now we're at $95,000 of income before any RMDs start. Then their first RMD hits. On $1 million balance, that's about $40,000. Now their income is around $135,000. That's the stack, right? That's the pension, Social Security, and the RMD. This is very similar to what I showed the couple who said I traumatized them. So let me tell you their story. They were in their early 60s. Both of them were still working. Between TSP and IRAs, they had about $1.2 million saved. They had no debt and their pension estimates looked pretty strong. If we look over here, John's pension would start at age 62 and would bring in a little over $55,200 a year. And Lisa's would also start when she retired at age 62 and bring in $54,000 a year. And they both start Social Security at 67 or around their full retirement age. So they both felt pretty good. When we built their retirement plan, we did what I do for every federal couple and ran the projections out into their 70s and into their 80s. When their RMD started, their income line jumped. In their mid-60s, their projected income was around $110,000 to $115,000 of income after one spouse retired, but before Social Security and RMDs began. Now, in their early 70s, once both Social Security checks were turned on, and in addition to both their pensions, the income started to climb well over $200,000. And when RMDs came into the picture, right here under the planned distribution column, that plus their current income jumped them closer to $400,000 in combined income, with the tax payments starting to climb well into the six figures here. And that's when they said, "You traumatized us with those RMD graphs, Tom." Now, they were half laughing when they said this, but you could also feel they were also very concerned. So I always have to say this as well because people leave comments on these videos. Yes, I understand this is a first world problem. It's still a problem for people with money that want to be able to keep this type of money. And that's the work I do. I help people keep their money. Okay, now the graph also showed something else. At those higher income levels, their Medicare premiums started to go up because of IRMAA. That's the extra charge added when your income crosses certain thresholds. And you can see that happening into their mid-70s and beyond, where if you cross certain thresholds, your Medicare premium can be increased by a couple $100s a month for that year, depending on where your adjusted gross income falls. So the question became, what can we do now in their early 60s so their 70s feel much smoother? So first, we looked at their gap years. Now for them, that was the window between when they planned to leave federal service in their early 60s and before when RMDs and both Social Security checks would all be turned on. So you can see this little valley here, where in those years their income was going to be lower. So we used some of those years to do moderate Roth conversions. And we chose amounts that kept them in reasonable tax brackets in those years, instead of waiting and having everything taxed later at once. So let's say we do Roth conversions from when John is 63 to age 67. And we'll do that up to the 12% tax bracket. So we go down here, we click refresh. And we see we added almost $190,000 more in tax adjusted assets. And we saved almost $160,000 in lifetime taxes. So not bad. But let's push it a little further. What if we filled up to the 22% bracket? Okay, now that's a bigger jump, right? We're adding $640,000 in tax adjusted assets. And now we're almost saving $1 million in lifetime taxes. And you can see the difference with the conversion. You can see your lifetime taxable income goes down on this one versus without doing the conversion. Now, second, we looked at their mix of pre-tax, Roth, and taxable money. Almost all of their savings were in pre-tax buckets. So any future income would have shown up on a tax return. Over time, we shifted some new savings into the Roth side. We also plan to draw a little more from pre-tax in their 60s on purpose to avoid building an even bigger pre-tax balance than they already had. Third, we looked at how much stayed in the TSP versus moving to an IRA when they retire. For some federal employees, it makes sense to keep a portion in the TSP for the stability they like. And for others, moving part to an IRA gives you more control over how the money is invested and how withdrawals are going to be managed. So in this couple's case, we plan to keep some in the TSP and move some to an IRA that matched the withdrawal plan we were building. So in doing all of this, their projected IRMAA years went down and their lifetime tax bill became much more manageable and predictable. Now, I do want to mention that Roth conversions are not for everyone. Moving money out of the TSP is not always going to be the right move. This is definitely not a one-size-fits-all strategy. It depends on your balances, your tax situation, your health, and what you want your retirement to look like down the road. But there are a few simple steps almost every federal employee in their 50s and early 60s can take. Step one is know your mix. Add up how much you have in pre-tax accounts, that's your traditional TSP, IRAs, and any old 401ks. Then add up how much you have in Roth accounts and taxable accounts. You don't need a perfect spreadsheet here. Even a rough percentage gives you a sense of how much of your future income will show up as taxable. Step two is map out your 70s income stack. So take your pension estimate, take your Social Security estimate for both spouses, then assume a simple RMD. If you want something quick and easy, you can just estimate around 4% of your pre-tax balances in the early RMD years. It's not going to be perfect, but it is much better than ignoring it. Step three is find your gap years. Look at the years between when you expect to leave federal service and when RMDs start. Those are the years where your income might be lower. That can be a great window to consider partial Roth conversions or drawing some money from pre-tax at a controlled rate. Step 4 is be aware of the Medicare thresholds. You don't have to memorize every dollar amount for this, but know that there are income levels where your Medicare Part B and Part D premiums can jump. Big one-time withdrawals or conversions in a single year can push you over those lines, and the premiums are based on income from 2 years earlier. Step 5 is decide if you want help. If you're listening to this and thinking, Tom, I don't want to manage my RMD graphs and Medicare brackets alone, that's okay. Most federal employees I work with feel the same way. This is where having a planner who does this all the time can make a big difference. Someone who can sit down with you, build the graphs, and say, here's what happens if you do nothing, and here's what happens if we make a few changes right now. So let me bring this back to you. RMDs are just the rules of the game when you have large pre-tax savings. For federal employees, the real risk is not knowing how RMDs stack on top of your FERS pension and Social Security until it's too late to do much about it. So if you start looking at this in your 50s and early 60s, you give yourself more choices and more room to breathe, and more confidence that your 70s and 80s will feel like the retirement you've worked so hard for. So if you'd like to see your own RMD path instead of just guessing, that's exactly what we review in a federal retirement blueprint. When you're ready and would like a personal walkthrough of your own numbers, click the link in the description and I'd be happy to help. And if you want to keep learning, the next video I would encourage you to watch is this one right here on TSP withdrawal options when you retire from federal service. So thanks for watching, everybody. I'll see you in the next one.